Is it possible to prepay expenses?
Yes. Those are some of the great benefits that we have as businesses. And this is a perk that I'm just throwing out there for those of you who have businesses. We're going towards the end of the year. This is, we are in November. Now, most people who are working, I'll tell my clients, guys, it is time, if you have things to buy, for the clients who are making money and we're looking for buckets to save on taxes, I tell them that it is time for you to buy, to buy. So basically, you can be looking for inventory that you can buy inventory that you will use for the next 1 year. And how do you buy it? You basically go and sign a piece of paper. Even if you don't have it in stock, you've already acquired those assets, right? You go out there based on your credit. You don't spend the money. You basically, the good thing, the great thing about the tax code is that the code section 162A allows you to be able to write off things that you acquired for which you've not yet paid the money. You bought them on credit. You can already write them off. That's why I was talking about a private jet before. I was telling you about buying vehicles. It's the same. You go and buy inventory. As long as you've signed that inventory has been transferred to you, the risk and ownership of that asset has been transferred to you, you can immediately write it off. So if you're struggling with tax, if you made a lot of money, which is a great thing, and you're worried about your tax, that's one of the easy buckets to avoid paying taxes, to reduce your tax burden.
Charles, you've explained prepaying expenses. Is it also possible to defer income?
Absolutely. Absolutely. Deferring income simply means that you have that income. So basically, I already made $1 million this year. Or maybe I made $2 million. I made $5 million. And I'm so concerned about taxes. This is November. I'm going to be, my November, December income is another $200,000 or whatever it is. Maybe it's $1 million, whatever it is. You could basically defer the billing of those for those 2 months and push them to January of next year. That way, that income doesn't come to you. Remember, you are going to account for all the income on a cash basis. As long as that money hasn't hit your bank account, it doesn't belong to you for tax purposes for that particular year. So you can defer those revenues and then push them into the next year. And that is a big, big way. If you do that for $200,000, guess what? If you're in 37% tax bracket, you just save yourself about $74,000 in taxes. If you did that and you're in the 37% tax bracket, just from a federal standpoint, you defer $200,000, you just save yourself $74,000 in taxes.
Wow.
So those are crazy numbers, but those are things that are available for you guys to do. Those are simple things that we throw out there. Yes.
Many of our clients are offered health savings accounts.
Yes.
It goes by the acronym HSA.
Yes.
Talk about how that works.
So HSA, I remember, HSA means health savings account. And this is especially great for young people. Young people who are not, and young and healthy people. You don't go to the hospital a lot, but your health insurance is still very high. The average household health insurance is at least $10,000 to $15,000 a year for a 3-person household. And if you're not going to the hospital, that is money wasted. And when you think about medical write-offs, the bar is so high because you have to beat that 7.5% floor to be able to even take it on a Schedule A if you qualify. So what I tell people is, why don't you, instead of buying this great policy for health insurance, buy a policy with a higher deductible so that you have access to something called HSA, Health Savings Account. The health savings account is a bucket where instead of putting that $15,000 in that great policy, you are putting maybe $6,000 in a less great policy, and then you're saving yourself another $9,000 or $10,000. And then the HSA allows you for a single individual to put in up to $3,750. This is 2023. So you put it for both spouses, that's about $7,500 that you're putting in there. You just save yourself that money from putting in that great policy that you're not using. And then you're putting it in that HSA whose only requirement is to have a high deductible insurance policy. So now you're putting, instead of putting that money in a bucket, which is just going to be gone because you didn't use it, you put it in a bucket which is going to be sitting there for you. And it is building. And that money, remember, it is tax deductible. And then not only is it tax deductible, that money you're saving it and you're investing it and it's growing tax free. So it's a great bucket to save money for those people who are healthy. If you have a healthy household, I'll tell you, this is open enrollment time for health insurance, right? If you're going through Marketplace or whatever. Just tell your employer, whoever is giving your health insurance, tell them I need a higher deductible policy. So you get a high deductible policy, which allows you to get an HSA, or you tell them I need an HSA because they know that you need an HSA. So you're putting money away instead of paying those high money. You're putting in an HSA. So the HSA becomes a retirement plan for you. So instead of throwing that money away, you're putting in an HSA. It's a retirement plan. The money is building. And then guess what? Crazy people like me, I'm going to self-direct that HSA. And then I could buy real estate with the HSA. I could do crazy stuff with the HSA. And that is money that when I get older and I'm going to my nursing home or to my one-on-one home, I have all this money seated there to take care of me. So that is the power of the HSA.
Why is good bookkeeping important?
This brings me to tax resolution. 90% of my clients who came to me for tax resolution, they came to me because they had problems with bookkeeping. The standard for bookkeeping is, if you look through, 2% of your revenue should be going to around your administration, around accounting services. That's the standard. Mm-hmm. Around 2% of your revenue should be going to accounting. In my community, most people build big businesses. They don't have an accounting system. Mm-hmm. They don't have a bookkeeping system. And when you ask them about the bookkeeping system, they refer you to their bank statements. Mm-hmm. Madness. And 90% of my tax resolution clients who were either bankrupt or they had liens on their assets, they had garnishments on their assets, came because anytime you wanted to help them, you don't have any source of information. The only power that you have against the IRS is your documentation. And whatever you think about bookkeeping is going to save you far more than anything of what we're talking about. So when you start a business, number one is documentation. And that is your bookkeeping. I see some great people, they start their businesses with the bookkeeping. Even when they have nothing, they're starting to do their books. And that's the way you will build a business. Because it allows you, one of the biggest benefits is that it gives you access to capital. When you want to get access to capital, they ask you for your balance sheet and your income statements. You are able to pull it. You're able to understand what part of your business is performing well versus what is not performing well, thanks to a bookkeeping system. If you don't have it, you don't understand anything. And you're able to file and reduce your tax burden because you have a bookkeeping system. 90% of people who don't have a bookkeeping system, they're afraid of deducting those things that they were supposed to deduct anyway, just because they don't have any supporting documents for it. So you're trying to be penny wise and super pound foolish. So bookkeeping remains the bedrock of your business.
What's the largest segment of the top 1% in wealth and earnings?
So when I think, let me understand what you're telling me here. You're asking me what is the top 1% of Americans who are making all this money. So if I think about the segments, America, to be in the top 1% is very easy. When you make $400,000 as net a year as a household, you are in the top 1%. The middle class, all the middle class, is all the people who are around the 300 and right down. And then below 75,000, you're considered low income, right? Something like that. You pay less taxes. And in America, a good chunk of people still earn less than $20,000, $30,000 a year. But most people are in the middle class. And then when you make over $400,000, you're considered in the top 1% of Americans. And when you're there, when you make $400,000 in income, you have the capacity to make $4 million instantly. Our program will help you do that through acquisition of assets. How much can you get in terms of other people's money? That is where you are building that tremendous wealth. You multiply your gain set by 10x, and then you move from there. That is why we say understanding America is the beginning of wealth, is the beginning of wealth building. I tell a lot of people, and I don't know if you have that, I tell a lot of people that you can do a lot of things. Many people in my community, they are so obsessed about building our communities where we came from, which is a great obsession. I love it. I tell people, before you build that, make sure your source of income is sustained. You cannot just be taking from here and building back home. Because the things that you're building back home in an economy, which is a weak economy, against a currency that is one of the weakest currencies, you cannot invest, you cannot work, generate income in hard currency and invest in shit currency. It's the other way around. And once you've invested and you have income generating, you can do whatever you want back home because you have investments that are giving you returns. So the beginning of your investment cycle should be in that hard currency before you get to do those things that your heart, it's more about the brain in terms of investment. And then now you can do what your heart wants with the money that you've generated from the investments you've made and in hard currency.
What's the ultimate use of OPM, and what is OPM?
OPM means the use of other people's money. And that is one of the bedrocks of a capitalist community. Capitalist societies are a system where creating money, wealth, on the basis of savings is so hard. And I'll tell you, about 70% of the middle class, remember middle class is up to 300 and above, 70%, these are statistics, 70%, about 70% of the middle class don't have don't have $1,000 sitting in their bank accounts. Constantly in that rat race. So what does that tell you? It tells you that building wealth on the back of savings is almost impossible. So now, the way the structure of America is seated is that you build wealth. What they call the smart people, the top 1%, they build wealth on the back of the middle class. So the middle class take their money. They have all their money in 401ks. They take their money and put it in insurance. They take their money, they take their money and put it they put their money all in those buckets that are growing gradually. And then what happens? The smart people, which is the top 1%, they go take that money and then use it. I invest $20,000 and I get access to $200,000 worth of an asset because the $180,000 is coming from other people's money through the banking system. All I need to do is to have the right credit, build the right assets, and the bank gives me all the money I want. That is leveraging other people's money to build wealth.
Explain the largest tax savings, which is the major conveyor to wealth building.
The largest tax savings, the concept is that tax is the largest conveyor to wealth. If you look through, for any middle class person, if you look through your personal income statement, your largest expense is how much you paid in taxes. There's nothing else that you've put that much money in. It's how much you paid in taxes. And the only reason you're paying taxes is because someone out there, which is called the IRS, which is called the government, believes that you cannot take care of your own retirement. So they're trying to help you build a retirement for you through Social Security. That's the major reason they're taxing you. So now that you cannot build your own, the government doesn't want you to leave to retire and be on Social Security because Social Security is a Ponzi scheme. And if nothing is done, so now you're not only feeding Social Security, you're also giving money for the government to be able to help people who are on low income and to whom they are giving food stamps. That's what taxes are for. So instead of giving those taxes, the government tells you that if you are not going to be in that same pot of soup, then help us do A, B, C, D, E, F. Take care of your retirement. Invest in assets. Invest in build businesses. Do things that are going to build the economy. So now, if you are doing those things that are going to make you somebody wealthy, well, they know that when you go to retirement, you're not going to depend on the government. The government gives you incentives. So one of the incentives is that you avoid paying all those taxes. And that's why the top 1%, the top 3% pay nothing in taxes. Because they are doing those things that the government wants them to do. And the government knows that those people are not people who are going to rely on them in the future. Remember, Social Security. How much is Social Security? The maximum Social Security that you can get in a year is $32,000. For most people in the middle class, they wouldn't be able to survive on that money. But that's the maximum you can get. And the alternative is to structure yourself in a way that you don't become dependent on Social Security. The government will give you everything. So the biggest conveyor to wealth is your taxes. If you can save on taxes, you're conveyed to wealth.
When someone is renting a property from you that you own,
yes,
how does that build your wealth?
Great. Let me tell you, one of the things that you and I should do, that you and I would always want to do, is to own our business locations. So when you're in a place like this, which is an office, you own it. Because when you are paying rents to someone else, you're basically building the assets of someone else. Remember when we build a trifecta? We tell you that on the trifecta, there are assets and then there are operations. Somebody is sleeping and he has an asset on this side and you're the one funding that asset. Why don't you convert that asset to be your own? You have your business, you own your office, and then you're paying your rent to yourself instead of giving it to build someone else's wealth. So you are the one paying your office, is paying your mortgage. It's around structure. So you have to own your office, your place of work. You have to own assets. The first place, your first rental property should be your office. That's your first rental property that you own. Yes.
Real estate tends to appreciate in value.
Yes.
How does that work when you're trying to build wealth?
So when you think about real estate, and this is a good one that I could stand on a board and really demonstrate it to you. When you think about real estate, and I tell people real estate is really, the world will tell you that real estate, 99% of all those who are in the top 1% have grown, have invested in real estate. So what does real estate do for you? Real estate does many things for you. Number one, to acquire real estate, you are basically investing just a small amount of money. And what? You're using other people's money. You invest 20,000, you get access to 200,000, and the 180,000 is other people's money. That's number one. Number two, now you get to $200,000, which is built for you, that the IRS, if structured properly, it allows you to take that money, which is a passive activity, and wipe against your ordinary activity, and then you don't pay no taxes. That's number two. So you are going to save even more money just because you invested that initial small money, got access to other people's money, and now you are able to take that money, that big asset which you never invested in, and wipe off everything. You didn't pay for it, but now you can wipe off even your own benefit. That's number two. Number three, you have given it as rental. It means that someone else out there is the one paying for PITI, which is principal, interest, taxes, and insurance on that property. Someone is paying the mortgage and everything for you. That's number three. Number four, you are, in most cases, the return on real estate, we always ask for 1%. 1% of the value. So I tell people that my rents need to be 1% of the face value of my asset, the value of my asset. So basically, if that was to happen, you always get a surplus on that rent, which means rents are higher in most cases than the PITI, and you get cash flow coming in. That's number four. Number five, you also, while that asset, while you have it sitting there, the appreciation over the last 30 years on real estate, over the last 30 years, just appreciation alone is over 9-10% per year over the last 30 years. That's number five. Number six, I could go on and on and on the benefits of real estate. And then number six, you can actually take the equity out of those properties and buy even more property. That while the value of the property, remember the value is going up, the mortgage is going down. So it's just so many layers of wealth building around real estate. So it's the number one. That's where millionaires and billionaires have stocked their wealth. McDonald's, for example, you tell people McDonald's is the number one provider of what? Of donuts. Their wealth is not in donuts. Where is their wealth? It's in their real estate. They are all in the major cities, in the most prominent places in the space. That's where the wealth of McDonald's is. That's where the wealth of most of these wealthy people is. The one place where in Washington, whether you're a Democrat or a Republican, they don't argue over it. You never hear any debate around real estate benefits because they all agree. It just goes under the radar. And we have the best benefits coming on because all of them are investing in real estate. They have the strongest lobby in America. So that's the power of real estate.
I've heard you say that asset protection is not just for the wealthy. Mm-hmm. Could you talk a little bit about that?
Asset protection is as long as you have an asset. Let me tell you, I tell people that when you don't have money, when you are still in that space where you don't have anything, the number one asset you need to protect yourself with, it's your personal life insurance. Your life insurance is the number one asset. for people who don't have money. Because if something is to happen to you today, that is what you're going to fall back on. If you don't have anything, the only thing that can easily give you $1 million, that you can write on your book that I have $1 million, is if you have some life insurance that's $100 million. You're paying maybe $100 every month. So when you don't have money, one of the key things you want to think about is, how do I protect my life with a living benefits policy? And that gives you something that now you have an asset. Because that asset, if you became inert and your brain is no longer functioning, if you have living benefit, that is going to take care of you. But you would never have accumulated that amount of money while you're there. So for richer people, you may want to reduce, you may think, okay, maybe I don't need that or something like that. But when you are still at the beginning, one of the first things you need is that life insurance. Because it gives you peace of mind. It gives you access to something you can lie back on. And it makes your family live at peace, knowing that the future is built for them. Yes.
How can someone access what you have to teach?
Great question. Great question. So the first thing is that people should subscribe to my social media pages. I have a great website, and I'm writing. We have this Dream Blueprint. It's coming in the form of a book. We have it in the form of a book, which is coming very soon. It's talking about mindset. It's an incredible book. And it will teach you some of these basics of understanding this. So apart from that, you can basically, you go through my web pages. We are building something which I don't want to talk about now. But also, you can join my program. As simple as that. Just join my program. We are out there. Call CHN Advisors, go to my website and join a discovery call. And then you are part of our program. Once you become part of our program, you are privy to all the information that we know. We are, and we can say this, we are constantly giving information out to the masses. And if I hear of something that is great out there, because we're constantly learning, I throw it out to my community. This is for my community. It is primarily to change the mindsets of our community so that the next generation of our people would be different sets of people. We will not only rely and be thinking that there are some people who are better than us just because they are doing something that we didn't do. But now we have that information. We are able to send our children, to make our children work for us. We are able to take advantage of all these different things, and so that we can become self-reliant. We can become our own American dream. That is my dream. Being able to change the whole community in which we are, so that we are now able to be part of not only that middle class, but become part of that top 3% or that 1%. That's my goal.
Suppose I just arrived in the USA.
Yes.
What's the first thing I should do?
Great question. So you arrive from the USA, and this is very important. I mean, it is important for everybody who's coming from other communities. And I want to say this most importantly to those of us who are first generation immigrants who are coming from Africa. You're coming from all these countries where it is a complete different system from the US system. The UN is the champion of the world when it comes to what? When it comes to capitalism. It means that capitalism means that these are financial thugs. That is the word capitalism. The meaning of capitalism means that financial thuggery. It is financial thuggery, which simply means, and I call this, I don't know how you want to look at it, but it simply means that the powerful, the stronger, the more equipped people are taking advantage of the weaker people. That's why people will come and cry that, we are not able to, we don't have health insurance in America, it's too expensive and blah, blah, blah. Nobody listens because that's the way the country is structured. We are not Canada. Canada is a completely different country. Their system is completely different. They provide health care for their people and things like that. It's a completely different. We are in a top financial system. So if you are strong mentally, you understand how the country works, you are going to take everything from the weaker person. That's the way capitalism works. Socialism is about a system where people, it is a system where people are working for the people. It's a system for the people. It's a system that is, you're governing a people for the people. It's a government for the people, by the people, and for the people, or whatever they say it. What does that mean? It means that we are working for our masses. The government basically owns all the things, and then it's trying to move to a process where it's going to be rationing it. The best case scenario will be a place like China, where you talk about pure communism. You talked about Russia, they had communism. But when you're talking about socialism, I think China is socialism. But most of our places in Africa, we're trying to emulate a little bit of all these things. And then we end up being a place where now the government owns everything. And then a few people are governing. And these people become very greedy. They now seize everything instead of doing what they were supposed to do and making it more of a communist state where we ration it. Now, a few people own everything and they're the ones moving and everybody is bowing to them. And they stay there forever. They become dictators. In places like Russia, they call them oligarchs. So the thing is, when you are coming to this country, when you move to this country from a state like that, where you are used to fighting and saving your hard-earned currency to be able to build whatever you're having, because everything is owned by some government person who is just there, who is stealing everything away from you. When you come to this system, you come with that system where you think that, I have to always be saving. And then you get to a system where the whole process is structured around spending. America will always survive because of spending, not because of saving. If you save in America, it's very difficult to save. The system is a system of capitalism means spending. So when you come to this country, you have to understand how that system works. Because if you try to save with all the things that are available to you, you find yourself difficult to save. So my first thing when you come into this country is to do the basic things. Learn how the system works. Educate yourself. Get through that process of income generation. You generate income. You learn how the system works. Work with people who understand the system. One of the things that we've had in our communities, those of us who are first generation immigrants from Africa, is that we basically do what the person we got here and met is doing. So if I came here and my brother is a nurse, I'll become a nurse. If I came here and my brother is a truck driver, the tendency is that I'll become a truck driver. But 90% of these people, 99% of them, don't have a clue about the system works. So you come here, you're staying in the country and you're thinking, oh, my brother is not helping me because he's caught in a rat race. When you come here, before you know it, you're also caught in the rat race. The only way to get out of that rat race is to see if you can easily go out through the cash flow quadrant, how you can move from being an employee straight to becoming an investor. That means you're moving from the top, from the middle class, from the lower group to the middle class, and straight you're moving to the investor group. And that will save you money because it gives you savings on your taxes. And then basically it gives you access to that American dream by accumulating wealth, accumulating assets.
Would you recommend that someone work in the USA and invest in Africa?
Great questions. I will, absolutely will. However, I have a caveat for that. Unlike most people in my community, I think differently about that. And the way I think about that is when you work in this country, you're working in very hard currency. It is the most powerful currency in the world. When you work in hard currency, you want to build assets in hard currency. You want to build wealth in hard currency. You want to use other people's money because this is the place. There is the biggest advantage of being in America is that you have access to capital. You need to do just basic things. Get your credit right. Get some income generation. And then you now have access to capital. As long as you're taking that capital and not using it in consumer items, things that are going to make you spend more, you are going to invest in assets that are going to generate revenue for you. Once you start generating assets in a good economy, strong economy, where the currency is powerful, then you can talk of being wealthy. Because when you buy an asset in Cameroon, or you buy an asset immediately in Zaire, in the Congos, in any of these countries, which has local currencies, you are investing your hard-earned currency in and generating revenues in very, very weak currencies. You cannot, it is hard to live in America on the basis of that income that's being generated from a weak currency. And the tendency is that that currency cannot even be used in your next neighboring country. The second thing apart from that is that that currency is very prone to devaluation, which makes it even harder. So my thing is, in as much as I want us to invest in our countries, because our heart wants us to do that, we have to generate income in hard currency first. Let's spend the initial years to become wealthy through the hard currency that we're generating here and have those assets that are going to be giving us passive income. Then now we can now invest where our heart is. Because we are not going to depend on the revenue of that from those sources, but we're going to be helping to generate income within that community. So that's the way I see it. That's my own way of seeing it. I am very much for investing back home. I am more about getting sources of income in hard currency here, because I can easily live in Cameroon on currency, on income that's being generated from the United States, than I could live in the United States from income that's generated from Cameroon. Does that make sense? Mm-hmm. Yes.
Mm-hmm. How would you advise someone who wants to buy their first rental property, invest in their first property? What'd be the best way to go?
The best way to go, if you're buying a rental property, is simple. The best way to go is, I tell people your first rental property is going to come from many sources. It could be, most people I get to help them with first rental property is because they had maybe a 401k, there was money in there. We took that 401k, self-directed it, and put it in a property. But my way is easy. The Dream Blueprint allows you to basically save on taxes. Your first amount of saving on taxes. In my program, you're buying real estate every year. You buy one property every year. And the more you buy, because you're buying using other people's money, and the only investment that you put in is that part that you saved on taxes. So if you are giving $20,000, $40,000, $80,000, $100,000, $500,000 to the IRS, you're giving your wealth away to the IRS. So if we can save that wealth by working with the strategists, you save that money and then we buy property. Every year we keep buying. And that's how you're building wealth, and then you're paying no taxes. Because when you accumulate assets, Section 162A allows you to be able to write it off using bonus depreciation, using Section 179, using normal depreciation. All those things allow you to be able to write them off. So that's my way. And if you're buying your first home, I wish I knew this when I bought my first home. I would tell you to buy a multi-family home, two duplex kind of home, two homes. One of them is going to be a rental. The other one is going to be where you live. And then that rental is helping you pay for the mortgage. That's the way I think.
Well, Charles, I've enjoyed exploring these topics with you, and I think you've answered all of my questions.
Thank you so much. I mean, it's always a pleasure talking to you because we get to talk about those things. You have some insights as a CPA. You understand some of these insights, and we talk about some of those things that are really pertinent. And I appreciate talking to you because some of those questions are basically going back to the community, to my own community. And I want to lift people around me. I want to be able to help people understand some of these basic things. And I know there are scrutinies around there. There's going to be people who are going to say, no, this, no, that. There's always a counter to everything. But I'm ready for any type of debate around any of these subjects. I believe strongly about what I'm talking about. And I know it works. It's working for me. And it works for my clients. And we can have all sorts of testimonies here. It works. This is the American dream. Thank you so much for today. I appreciate you always.